Today we are diving into something super crucial for every NRIs who's planning to sell property in India. You know what triggered this video? Just last week I was consulting with an NRI client from Texas who was completely surprised by the new tax implications on property sales. That's when I realized we need to break this down into detail, especially with the recent changes in the tax laws. So today I am going to walk you through a real life case study that will help you understand exactly how to invest your property sale proceeds. And trust me, with the new flat tax rate for NRIs, this has become more important than ever. So let's dive into our case study. Imagine you sold your property for 2 crores. You bought this property 14 years ago for 18 lakhs. Now, here's something really important that NRIs don't realize. The indexation benefit that was previously available has been removed. But instead of the indexation, now there's a flat tax of 12.5% on your capital gains. Let me break down what it means for you. Your capital gains would be 1.2 crore. That's your selling price of 2 crores minus the purchase price of 80 lakhs. With the 12.5% tax rate, you are looking at a tax payment of 15 lakh rupees, which leaves you with a 1.85 crores to invest. Now here is where things get interesting. I am going to show you 3 different investment strategies for this money, and believe me, the numbers might surprise you. These aren't just theoretical calculations. These are real world scenarios that I have helped my clients navigate through. So let's take scenario number 1, the capital gains bond strategy. Now, even though you've already paid your capital gain taxes, capital gain bonds can be part of your investment strategy. Let's say you invest around 50 lakh rupees in these bonds, which is the upper limit to invest in capital savings bond. Now, these bonds offer a 5% return on your investments, and you don't have to pay any capital gain taxes if you invest this 50 lakhs into capital gain bonds. So after considering that you pay zero taxes on the interest also, your annual returns on these bonds would be somewhere around 2.5 lakh rupees, assuming 5% returns. The remaining 1.5 crore goes into an NRE fixed deposit earning 7% interest. Now after zero taxes, this gives you somewhere around 10.5 lakh rupees per year. So your total annual returns comes down to around 13 lakh rupees. So in total, you are looking at an annual returns of 3 and 10 lakhs, which is 13 lakhs. Not bad, but let's see how this compares with other options. Now let's come to scenario 2, which is pure NRE fixed deposit. Now here's where it gets interesting. If you invest the entire 1.85 crores left after paying the 15 lakh rupees capital gain taxes in an NRE fixed deposit, which currently gives a 7% interest after tax, you are again looking at a 13 lakh rupees annual returns. Now this is completely safe if you make this NRE fixed deposit with a reputed bank. So to understand here, if you put money into capital gain bonds and you save taxes, but it gives you a combination of 5% and 7%, the annual return that you eventually end up making is 13 lakhs only. But if you pay the taxes and put the remaining money into a 7% NRE fixed deposit, you still make 13 lakh rupees. So both these scenarios are same. And the only disadvantage of first scenario is that the 50 lakh rupees that you put into bonds are completely locked for 5 years. Whereas the money in your NRE FD can be 100% accessed whenever you need it. But wait, we haven't discussed about the option 3. So let me explain scenario 3 for you in detail, which is the mutual fund strategy. Now this is for those who want to make your money work harder. If you invest the entire 1.85 crores into a well-diversified mutual fund portfolio targeting a conservative return of 12%, your annual returns after considering the 12.5% long-term capital gain tax on equity investments could come to somewhere around 23 lakhs. That's almost double what you will earn in the other two options. Now I can hear some of you thinking, but Alok, what about the risks? And that's a fantastic question. Let me break down the pros and cons of each approach. The capital gain bonds with the FD strategy gives you a mix of guaranteed returns but locks away part of your money for 5 years. The NRE FD route offers you complete safety with decent returns, but you might be missing on the growth opportunities. Whereas the mutual fund approach could potentially give you highest returns, but yes, you need to be comfortable with the market movements. So here's something really important that I tell all my clients. It doesn't have to be a all or nothing kind of a decision. You could create a hybrid approach based on your goals. For example, if you need regular income, you might want to put 60% of the money into fixed options like NRE fixed deposits and 40% money into mutual funds for growth. Let me share a real example where we end up creating a hybrid portfolio wherein we put 50% money into fixed deposits for regular income and the remaining 50% into mutual funds for growth. This way, we are getting best of all the worlds. We are getting safety, we are getting regular fixed income, and we are also getting growth potential. Let me explain you this through a table. So as you can see in this table, there are two options. One is the 100% safe route wherein you put all the money into an FD, and the second is a 50-50 hybrid strategy. So from a 2 crore property, if you paid 15 lakhs as taxes, the remaining 1.85 can either be put into an FD which gives you 7% return, or you put half of the money into FD and half of the money into mutual fund. The average return in this hybrid strategy will be somewhere around 10%. Now, if you see, the same corpus of 1.85 crores in first strategy after 5 years becomes 2.6 crores. Whereas in the second strategy, it becomes 3 crores, which is almost a 40 lakh rupees excess money generated. Similarly, if 1.85 crores is invested into the first strategy, which is the FD strategy for 10 years, the end amount comes down to somewhere around 3.6 crores, which means your money doubled in almost 10 years. But if you see the second approach, your 1.85 crores end up becoming 4.8 crores. And on this portfolio, if you see the income that is generated in the 10th year, the 3.6 crore being in an FD of 7% will give you 25 lakh rupees. But the 4.8 crores being in a hybrid strategy will give you 48 lakh rupees, right? So look at these numbers carefully. The difference between these two strategies after 10 years is nearly 1.2 crores. And what's even more interesting is the annual income you could potentially generate in the 10th year. It's almost double with the hybrid strategy. This is the power of long-term strategic allocation. Before I wrap up, here are 3 golden rules that I want you to remember. First, it's better to look beyond real estate to save taxes on real estate capital gains. Second is don't chase high returns. Think about your income needs and your risk tolerance. And third is to consider creating a hybrid portfolio that serves multiple financial goals. Remember that this is not a financial advice and the video is just for education purposes only. So if you find this analysis helpful, don't forget to hit the subscribe button and join our NRI only WhatsApp community, the link for which is in the description below. And if you have any specific questions about your property sale proceeds, drop them in the comments below. I would personally read and respond to each one of them. And if you are somebody who is selling a property, please feel free to reach out to us. I would want to create such scenarios for you also, customized according to your financial conditions, and help you out to live a best possible financial life. Thank you, and I'll see you in the next.